All right, folks, welcome to the show. Jason Bible, Texas Real Estate Mastermind. Today, we're going to talk about investors, deals falling apart, deals that are failing. If you are listening to the news right now, there are a lot of challenges in the multifamily real estate market. And let me explain what's going on. If you're not in the know, there's a couple of things that are happening. One is the banking crisis that was earlier this year. The banking crisis is one of the local and regional banks are the ones that fund most multifamily deals out there. You get into the technical term, it's non-agency. So local bank, you're an investor and you want to go buy a 50-unit apartment complex, 100-unit apartment complex. You're going to field a number of offers from local or regional banks to do the deal. Since the banking crisis, it has been a real challenge for multifamily operators to get into, long-term financing, less than a year or two. So the banking crisis caused one problem. Interest rates are a whole nother animal. There were a lot of deals done in the last couple of years that were predicated on 4 and 5% interest. In fact, some sub 3%. So those deals are starting to have some real challenges. Add on top of that, all of the inflation. And we're now experiencing a marketplace where taxes and insurance have just skyrocketed. In fact, I was looking at one of our deals. Last year, we paid $29,000 for property insurance. This year, it's $37,000. So a $30,000 policy turned into nearly a $40,000 policy. Went up $8,000 in a year. No losses. We didn't have a hurricane. We didn't have floods. We didn't have a fire. Didn't have any of those things. And then the policy crept up $8,000, like a 25% increase. Absolutely insane. You combine that with taxes. Taxes are skyrocketing in Texas. Why? Because these properties have gone up in value. It's been really interesting to watch. So to me, when I hear about real estate deals falling apart and passive investors and investors that have put their money in these deals start throwing fits, I immediately say, well, what is an operator supposed to do? When someone invests in your deal and interest rates double in 9 months, how is that the operator's fault? I'm reading a lot of really interesting things on Facebook, social media. I'm getting really interesting messages. I'm tuned in with how can I put this? I'm tuned in with the grapevine, if you will, the rumor mill, and the things that are being said about other investors who've had 10, 15, 20-year track records are absolutely absurd. You have no control over the cost of construction. You have no control over interest rates. You have no control over taxes. Got no control over insurance. And yet some of these guys are being excoriated in the media. And I really don't get it. So I came up with this philosophy. And it was something I didn't realize a year ago that I realize now. And here is an evolution of what one of these deals looks like. You go into a deal, looks like a good deal. You guys are making some money. You're doing some turns. You're increasing rents, dropping expenses. And then all of a sudden, you've got to refinance. Or maybe you're already into long-term mortgage and your taxes just went up 50% and your insurance just went up 50%. And now the deal is cash flow negative and you need a capital infusion. Now, savvy investors, and probably a better way to put it, mature investors, completely understand, hey, this is not ideal, but this is the only way we're going to get out of this. Put some cash in here to float the negative carry until rents rise. And then as rents rise, then we can start cash flowing again. One of the things I realized when folks started getting margin called or capital called is that in the perception from investors is, well, I don't want to throw good money after bad. And I'm like, well, what do you think is going to happen over 5 years? Over 5 years, that deal is going to make a ton of money. It's just not making a lot of money right now. And one of the things I watched is, I wouldn't call him a friend, is a colleague who went through a pretty large capital call and the deal still ended up failing. He did a second capital call and nobody voted for the capital call. And he basically said, look, this is the only way we can get out of this deal. You either put a couple more chips in here or you're going to lose the whole pot. So what ended up happening? They didn't put the second capital call in, and the whole deal fell apart. Went into foreclosure. Everybody lost everything. So now this guy is taking the heat. The operator is taking the heat for a deal that failed. And I said, well, wait a second. Is he supposed to put up all the money for the capital call? In a lot of these scenarios, the operator only owns 20%, 10%, maybe 40%. We've got one deal we own 40%. So the lion's share of the return falls on your passive investors, your limited partners. So who's really responsible when it comes to a capital call for all of these things occurring that are completely out of your control? And you got to think about it as an operator. It's like, well, our cost of construction went way up. Well, who's at fault there? Inflation? You going to call Jerome Powell and complain to him? Because it's not like the operator's got a choice on how much a 2x4 costs. I mean, at one point, what was it, like $50 a 2x4? If you guys remember that about a year ago, it was absolutely wild. MDF was like $30 a sheet. Hey, we got to put a roof on this thing at $30 a sheet. Like, it was absolutely insane. So what's a guy supposed to do? And that's the real interesting point. That's the real interesting piece. When the operator says, look, I only have 20% of this deal. I'm willing to put in my capital call for my pro rata share of the deal. But if you guys don't put your other 80% in, you're going to lose everything. So when they don't put their money in, everybody loses everything, and then they blame him. It's like, what are you blaming the operator for? You guys didn't have confidence in the deal. You got scared, and what happens when you got scared? You lost everything. Now you run around town blaming this poor guy, which is absolutely absurd. It is investor maturity that allows you to stick with the plan. Now, there are some deals out there that legitimately you're just going to lose everything and walk away. Like, there's just not, you can keep pouring more cash and more cash and more cash, and this thing will not turn around for years, and it might make a lot of sense. Cut bait, move on to the next one. It's just that's just kind of how it is. There's not anything else you can do about it. So when I look at what's going on in real estate right now, I am watching real closely who the mature investors are. I'm about to do another capital raise, about $5 million capital raise for a project that's not in real estate. I've got a development deal I'm working on right now that I'm probably going to raise a few $1,000,000 for. And I'm watching how investors handle stress. And I'm watching how investors or limited partners treat their general partners. I'm watching some things that I know general partners are doing that they shouldn't be. And I could see it. There's some folks that are kind of sneaking around, and I'm like, you're not really sneaking around that well. So the reason I'm watching that is I've got more investment opportunities out there, and who do you really want to work with? Do you want to work with the people that as soon as things go a little sideways, they freak out? You're like, look, man, I can't. The interesting thing is when times get tough, how many other things happen? I've got a buddy of mine. I know his other deals are doing great. He's got one deal that's fallen apart, went into foreclosure. And 9 times out of 10, what that means is the lawsuits are going to start flying. And of course, there's going to be no merit to him. He's going to stand there. First of all, you can't even really go to court. You actually go to arbitration. That's what most of these documents have in them. When you're in a syndication or a fund, it's arbitration. And a lot of folks think they're going to get all this money. At the end of the day, the max you can get out, the absolute max, is what you put into it. Hey, I put $100,000 into this deal. I thought I was going to make $300,000. I'm going to sue him for $300,000. Like, that's not how it works. The max you can recover before legal fees is whatever your initial capital was put in. I put $100,000 in, $200,000, even $1 million. And unless there's some egregious Sam Bankman-Fried FTX level fraud, you ain't going to get a dime. It's just the way those documents are written. If they're written by a really good securities attorney, we work with a couple here in the U.S. If they're written by a really good securities attorney, it basically says the minute your money is in this deal, it is 100% at risk and you can lose everything. In fact, the only thing that document protects you from is any recourse from your investment. Meaning, if the property's sued, literally it's just your investment that's at risk. Now, in the case of gross negligence and some of these other things, obviously that's a completely different scenario. But if the operator was just a bad operator, or if the deal just didn't work out and you lost everything, That's called investing. I'm actually working with my attorney right now on a couple of these syndications right now. And we kept talking about it. He said, look, you can't expect to not lose if you call it an investment. I mean, there is a pure risk aspect to all this. And as long as you disclose it, hey guys, there's no guarantees here. You can make a lot of money, you can lose it all. It's very simple. So when I hear investors whining and complaining, or I hear the rumor mill, just taking some guy through the woodshed, and I'm like, dude, don't you realize you're an investor and you can lose everything in this deal? One of my favorite deals to talk about, it was the craziest one I had. I lost $250,000 on one house. And a whole bunch of things happened. Maybe I'll talk about it on another show. My loss ratio, when I was flipping 100 to 150 houses a year, our loss ratio was 1%, meaning 1% of the time we would lose money on a house. Now, I'll tell you this. My lenders never lost money. My lender still got paid. If I did, some sort of partnership agreement, they always got their money back. But man, it was, we lost 250 grand on that deal. Our lender did really well on it because they had held it for so damn long. But everybody's always made their money. And the other thing I'm seeing in the marketplace too is these deals are getting a little more expensive, meaning construction's going up, insurance is going up, just all the inflation stuff I talked about earlier. And I'm hearing people talk like, oh man, I think this deal's going to fail. What's going to happen? And I'm like, the deal hasn't failed. It's just going through a troubled time. I've got a syndication right now that's got a 7-year run on it. We're in year 3. And it's interesting to see folks where it's like, what's going on here? What's going on here? I'm like, guys, we're not even into the first quarter yet of this game. Like we're still early on. So it's interesting to watch. Now, are there investors that are absolute scumbags? Absolutely. If you guys read, there was a big Houston foreclosure. The rumor on the street is, I think it was $250 million in real estate. The rumor on the street is they took the money and jumped on a plane and flew out of the country. That's literally the story that's being told right now. I mean, these things went into foreclosure in like 6 months. It was crazy. So that's kind of a whole different story. But if you're an operator, you're in the middle of construction, and all of a sudden there's no takeout financing, like what are you supposed to do? I mean, and the deal falls apart. I mean, you bought it. Actually, what's funny is all investors sign the same documents. So when you're a general partner, you put together a group of documents called the PPM, Private Placement Memorandum. And it's made up of a couple of documents. One of them's the operating agreement, and the other one's like the pro forma, the business plan's a better way to put it. So there's an operating agreement for the LLC, and then there's the actual business plan. And before a single dollar is taken from an investor, that's reviewed by your securities attorney. You have to submit a bunch of documents to the Securities Exchange Commission. And then you distribute those documents before anyone sends a single cent to you. And they got to read it and sign it. And I always say, hey, look, if you don't understand documents, you can talk to my attorney or you can hire your own attorney. Like it's not that big. Just read the documents. And in those documents, if you have a good securities attorney, this is what it says. You can lose everything. And here are the 9,000 ways you can lose all your money. My joke is a good PPM will say something like this. It'll be 100 pages long, and it'll be 99 pages of how we're going to lose all your money. And then the last page is how we're going to make money. That's really what it is. It's a giant disclosure document. Hey, Mr. and Mrs. Investor, we could lose everything. Are you guys cool with that? And every investor I know says, well, yeah, that's investing. We could lose everything. That's why the returns are so good. If you don't want to lose anything, go into treasuries. They got bonds, they got notes. Go and buy you some treasuries. I don't know what they're trending at right now, 3, 4, 5, 6%. Go get you a CD for 5.5%. Like for a lot of y'all, you're looking for, 6, 7, 8% return. The difference between 5%, let's say a treasury is trading at 5%. And then someone offers you an investment at 8%. That delta there, 5 minus 8, is 3%. That 3% is called the risk premium. It's a finance term. Let's say someone offers you a 12% note. Oh man, I need $100,000. I'll pay you 12% for a year. Cool. If treasuries are trading at 5%, 5 minus 12 is what? 7? So at 7%, that 7% delta is called the risk premium. Well, how much risk is in there? About 7%. But this whole idea that, investing's risk-free and you don't need to, worry and these investments are risky. According to the FTC, the only investments that aren't considered risky are treasuries. So everything else is risky. Everything else is risky. So if you're going to be an investor, you got to be mature. And if also you're going to be an investor, you can't put all your money in one deal, or you can't invest all your money, because you will have a capital call, 10%, 15%, 20%. Hey, I put 100 grand in. You're going to need, I would keep 20 to 30 grand just sitting on the sidelines. At least 10%. You can walk in, hey, we got a capital call, cool. Here's 20 G's, let's keep going. So be on the lookout, guys. It has been fascinating to watch. Investor maturity is a real thing. Everybody talks big when everybody's making money. But the real heroes are born when the market is on fire and deals are crashing. It's been real easy to make money the last couple of years. And this last year, with inflation and interest rates, it's been tough. But here's what I know. The real operators that can survive this marketplace are going to be sitting pretty in the next couple of years. I told the team we were having this portfolio analysis of all kinds of stuff. And I said, I think this is going to break by February. And I won't get into all the numbers. I will in our market update, our annual market update. It's actually in March. But I'm like, look, there are troubled deals out there. They can make it to about February. They're going to be looking pretty good because I think rates are coming down next year. My prediction this year was that rates would break in Q4, and they have. If you look and see what happened the week of October, the last week of October going into Halloween, rates went down 0.5%. They were like 8.1 all the way down to like 7.6. They went down fast. And I think it's going to continue that trend through 24. Buddy of mine has coined the term survive till 25. We're talking about 3 and 4% mortgages in 2025. Now, here's why that's important for you as a real estate investor. When rates dip below 6%, meaning 5 and some change, this market is going to be absolutely on fire. And here's the challenge. There's no inventory. We're going to have less than 4 million homes sold in the United States. That has not happened since the 90s. So with little inventory, the little demand that we have is keeping prices up. So what happens when the demand comes back as interest rates rise? These values are going to skyrocket. I'm doing a bunch of research right now. And my prediction is between fourth quarter here in 2023 and fourth quarter 25, we are going to see real estate rise by about 25%. That's my low number. There is a strong case, a 50-50 chance it's 50% in 2 years. It's going to look just like COVID all over again. December 2019 to December 2021, houses rose 50% in damn near every market across the country. And it's about to happen again. It's pent-up demand. That's all it is. That's what happened during COVID. Everybody got stuck inside for months. And they were like, maybe I should buy a little bit bigger house because, living in this little teeny house and being locked up kind of sucks. So what happened? Everybody went out and bought real estate. Then rates went down. Oh, then it went crazy. Same thing's going to happen in 25. I was actually drinking beers with a buddy of mine who's a fantastic mortgage lender here in Houston. And he said, he keeps reiterating this to me every time we hang out. Jason, I have never had a list of clients this long waiting on the sidelines, ready to buy. He's like, they're just waiting for rates to stabilize, not even go down, just stabilize. What do you think is going to happen when rates hit 5, 5.5, 4.5? It's going to be an absolute frenzy. Thanks for listening to the show. You can visit us at mrtxre.com. It's Jason Bible, Texas Real Estate Mastermind.